I mean, there's a lot of pieces to that. I think, gold's been going up for the last, I think, a couple of years simply. I think the central banks have been slowly accumulating and investors are accumulating. But the big run up that we really saw, I think, from September to where we are now for gold, silver, and miners, really, I think that was even more so of the mass market participants. It was kind of herd mentality. People started to catch on and really started to chase it. I think there was a pretty big level of FOMO over the past couple of months. If you weren't in precious metal space, you felt like you're missing out. And we hit a tipping point really kind of in October where, it was so intense. The amount of emails and comments and questions about gold and silver that I was getting in emails and from members and stuff, it was so thick. Like people who weren't in it felt like they were missing out, and people who owned a bunch of it still thought
Yeah.
they didn't have enough. Like it was insane. Like it doesn't matter. Like so, this last run up, I think, was definitely a herd mentality play. But I do think there's still underlying accumulation going on. This recent pullback that we've seen in gold and silver, it's just a little bit of air getting let out of this kind of overbought market. It just ran up too quickly with too much of the mass kind of market participants. And so it's just trying to shake them out. I do think we're going to see gold and silver go a lot higher. I think gold potentially another 25, 30%. I think silver could
Oh,
go
wow.
50, 60, 70%. And that's the same with platinum and palladium. So
Yeah.
right now the market's just trying to work off a little bit of an overbought market condition. It's trying to shake out some investors. And it's doing a good job because back in October, everyone needed gold and they need more of it. And then like as of like 2 weeks ago, people were actually scared. They thought it had topped and they're like, I don't know about gold anymore. And so now gold's putting in a bottom. So I play the sentiment extremes along with technicals, and the sentiments give you a really good idea of turning points, overbought, oversold conditions.
What we're seeing right now in gold and silver isn't random. It's the perfect mix of long-term buying and short-term emotion colliding. For years, central banks have been quietly stacking gold, and smart investors have been accumulating too. But the real explosion we saw from September onward? That was pure herd mentality. People suddenly realized precious metals were taking off. And they rushed in because of FOMO. And the crazy part? Even people who already had heavy gold positions felt like they still didn't have enough. That's how intense the sentiment became around October. Emails, comments, questions, everyone wanted gold, and everyone thought they were late. So why the pullback now? It's simple, the market overheated. Too many people piled in too fast. This dip is just the market releasing some pressure, shaking out the weak hands who chase the top. But look at the bigger picture, gold still has room to run, potentially another 25 to 30%. Silver? It could be gearing up for a massive 50 to 70% move. Same story with platinum. Right now, we're in that classic reversal zone. 2 weeks ago, people were panicking, thinking gold had topped. Suddenly, the crowd flipped, and gold is forming a bottom. This is why sentiment matters. When the crowd is overly excited, we get tops. When the crowd is scared, we get bottoms. And right now, sentiment and technicals together are pointing toward the next major up move for precious metals.
So if we were to look over to silver and we could take this recent low where it really started to break out of this kind of bull flag pattern, we can get an idea of where silver upside targets are. And silver's already had a very nice run. You can see the next conservative, this is the most conservative kind of target for silver, is about 56 and then about 63. Now there's a couple different ways we could draw this. Now if you're like if you want the real bullish outlook for silver, saying, okay, well, here's a standout low, here's a standout high, here's the current pullback. This will tell us kind of where that next move is, which is about $71, $72 for silver. Now, I usually don't gun for the big targets. A lot of people always like to put those on because people love big targets. But the reality is I like to stick with things that are likely to get hit. The problem is if you put these big targets on things, Steve,
Yeah.
people throw risk out the window. They're like, holy crap, look how much I could make. And they're like, they put in a huge portion of their portfolio. And then when it does backfire, they get absolutely slaughtered. So I like to take these very conservative approaches, and I like to hit targets. I like to trim profits, move my stop up and kind of play it that way versus reaching for the sky and then missing it and being like, wow, I rode it all the way up and then I rode it all the way back down because it didn't hit this pie in the sky target that somebody screamed out, right? So I generally don't throw out big targets. I could put out way bigger targets and everybody would watch the videos, but then they're always disappointed and they're like, it's taking too long, it's not working. And they also throw, my biggest thing is trying to manage people's emotions and their money. Not manage their money, but manage the risk their portfolio has. And everybody throws always the biggest targets out and it makes people make
Yeah.
stupid decisions. They just over bet, right? And I don't want people to, I've done that. I've blown up 3 accounts. I've been bankrupt before.
Yeah.
I've gone down that path and I would much rather hit a bunch of first, second, third base hits over and over and over and over again and miss
Yeah.
out on some really big rallies. But no, I just kind of keep growing and don't have to worry about, I keep risk in control. That's my whole focus. I think they kind of move together. I really kind of I put gold and silver in the same category. I put miners more or less in the same category. They're kind of all one trade. It's just some move more than others, right? I like gold the most simply because when chaos hits, gold can keep moving up, but silver might get hit, miners might get hit. I like to look at the stock market like the ocean tide. Like what happens to all boats when the tide goes down? They all go down, right? So the nice thing about gold and silver is they're a commodity outside of the stock market. So when we're in a bearish environment or there's selling in the stock market, meaning the tide is going down, if you hold gold miners, those gold miners are little boats trying to stay up while the tide is going down. So you might as well just shift out of the equity space and go into the physical metal side of things. So you don't have that tide pulling on you. Gold can just keep rocketing higher, have some really nice upside with a lot less volatility than miners. Silver, to answer your question, how do I see silver? I don't really look at the metals or anything really so much from like an industrial standpoint. I still look at it strictly as people move to precious metals when they're nervous and scared about the financial system. And silver is kind of like the little brother or the little sister. It's really volatile. It usually follows the big brother, which is gold. And it's more emotional. It's a smaller market. It moves fast.
Silver has already made a strong breakout, and the charts show clear, conservative upside targets around $56 and $63. The more aggressive, super bullish target sits near $71, $72, but chasing those big numbers is where most investors get burned. That's why seasoned traders focus on realistic targets, take profits, and manage risk. Big predictions look exciting, but they push people into oversized positions, and when silver pulls back, they get wiped out. As for the metal itself, silver still tends to follow gold. It's more volatile, it's more emotional, and because the market is smaller, it moves faster. Gold is the steady leader, silver is the explosive follower. He also makes an important point: miners and stocks move with the tide of the market. When the stock market drops, miners usually fall too. But physical gold and silver sit outside that system, which is why during fear and chaos, gold keeps climbing while everything else sinks. So yes, silver can run, but smart money focuses on steady gains, not sky-high fantasy targets.
I have this is the chart of the NASDAQ, and it's color coded. It's based on sentiment, and more or less it's telling us what people are kind of doing with their money. So when it's deep green, it means there's a lot of money moving into the market. People are bullish. When it's light green, it means it's weakening. Yellow means it's neutral. Red means there's some big bouts of selling. Deep red means there's some distribution, like big money is flowing out. We generally want to follow ride the coattails of big money flows. And so you want to avoid the market when it sells off, and you want to know when the sentiment is changing. We're starting to see some big bouts of selling in the market right now where we're at. So there's definitely some distribution going on. This is one of the tools. This weaves in some technical trend analysis. It weaves in some cycles, and money flows between about 8 different asset classes. So this is telling us which way money's flowing, because if money's flowing from, say, utilities into the stock market, then we know they want to take risk. But if money's flowing into utility sector, they're moving for a defensive play. Utilities, first off, they pay dividends. Second of all, it doesn't matter what happens to the economy, we still need electricity, we need running water. So the utility is not going out of business. So when people are nervous, they move to utilities. And it's the same with gold. When you see gold, running up, that's like people are nervous about stuff. They're looking for protection. And usually gold's a few levels higher. It's like, no, they're worried about currencies. They're worrying about government. They're worried about all kinds of much bigger things, not just, where to run in the stock market.
Right.
So that's a couple of the things. The other thing I like to follow here is this. We have this little indicator, a couple different indicators on our 30-minute chart that we follow here. It tells us when the market gets into these kind of overbought, oversold conditions. I'd need to kind of break it down in a nutshell from really high level. Let me just grab a pencil here. But more or less, if we zoom in on this chart, let me just zoom right in. So it tells us when we have very short term, this is very short term sentiment. So when this green indicator spikes above this blue line, this is called panic selling. And it usually tells us once it spikes and starts to reverse back down, usually the market's put in a bottom. It's telling us how many people on the New York Stock Exchange are selling shares on the bid. They don't care what price they get out. They're literally hitting market order. They're just like, get me out, get me out. Yeah. And when that spikes up to a ratio of 3 or more, meaning there's 3 people hitting the market button to 1 person kind of buying on the ask, that usually signals a short-term low. It's just an extreme level. Everybody's running for the door. And typically a contrarian play is when everybody's going in one direction, you should probably buy it. It's probably a good deal. And then the market will generally have a bounce and move higher, which it did. The next day, the market had this big gap up. And believe it or not, the next indicator is our FOMO indicator. This is telling us it has a huge move up and now everybody wants to buy it. And they literally go from selling it to like, now they need in. And it was overbought all day in the FOMO indicator. And then the very next day it gaps down. And we actually had this spike up within the 30-minute chart here, but it spiked up and everybody bailed back out in the morning. So, these are very short-term charts, but it allows me to get a gauge on what's doing. And then of course I can branch out to daily charts with similar type of analysis and what different sectors are doing of what the market sentiment in a nutshell is telling us. The other thing is like these lime green areas. This is when you're in an uptrend and we get lime green bars. That's telling us that the price has moved too quickly to the downside and it's kind of short-term oversold. So once it's oversold, you're like, okay, well, once it runs out of steam and starts to reverse, it should start to move higher and start another uptrend and eventually go higher. You couple that with panic selling and you can really nail some short-term pivot lows in the market. You can see over here, we had some panic selling short-term. Well, it was right over here. The market opened, we had panic selling, and then the market goes in rallies higher.
Chart of the NASDAQ is color-coded by sentiment, and it basically shows where investors are putting their money. Deep green means strong buying, people are bullish. Light green shows weakening momentum. Yellow is neutral. Red means selling pressure. And deep red signals distribution, big money quietly getting out. Right now, we're starting to see those deep red signals, which means smart money is leaving the market. And that's important, because you always want to follow the flow of big money, not fight it. This tool tracks trends, cycles, and money flows across multiple asset classes. For example, if money is moving from utilities into stocks, investors are taking on more risk. But when money flows into utilities, a defensive, stable sector, it means people are getting nervous. Same with gold. When gold spikes, investors are protecting themselves from much bigger concerns like currency instability and government risk. We also look at short-term sentiment indicators. When the green line spikes above the blue line, it signals panic selling, people hitting market orders just to get out. That usually marks a short-term bottom, because when everyone is running for the exits, contrarian buyers step in. Then comes the opposite, the FOMO indicator. After a big bounce, everyone suddenly wants back in, and once that FOMO spikes, the market often pulls back again. These quick flips between panic and FOMO help us read short-term sentiment. On the daily charts, the lime green bars show oversold conditions during an uptrend, a signal that momentum may soon reverse higher. In simple terms, watch money flows. Watch sentiment extremes. They tell you where the market is going long before the headlines do.